Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is May 21, 2026. We're Elena and Marcus.
Glad to be here.
So today, we're looking at a market that is aggressively pricing in a perfect fairy tale.
Right. It's what we call a conditional soft landing.
Exactly. But if you look under the hood at what central banks and institutional investors are actually doing, well, someone is lying. And let's find out who. We're going to unpack 4 critical themes from today's data deck to show you exactly where the cracks are forming.
We'll start with the macro environment and global rates, specifically examining a pretty severe divergence in the Treasury yield curve, where hawkish Federal Reserve signals are colliding directly with geopolitical relief.
Yeah, and from there, we'll pivot to equities and tech. We'll be breaking down a multi-billion-dollar artificial intelligence euphoria wave coming out of Asia, which is essentially acting as a smokescreen for significant profit-taking in U.S. mega-cap tech.
Third, we'll look at commodities, exploring why oil dropping below $98 a barrel on Iran deal optimism is really the linchpin for this entire market rally.
And finally, we will bring it all together in our synthesis. We'll expose the hidden risks lurking in credit markets that you need to be aware of right now.
Indeed. The signals coming from our daily desk data are telling a highly specific story about how institutional capital is repositioning, and it's entirely dependent on a few precarious variables just, holding steady.
Right. So let's begin with the biggest macro driver of the day. If you're managing a portfolio right now, you are watching a real tug of war between inflation fears on one side and geopolitical relief on the other.
And this tension is playing out vividly in the Treasury market. Looking at today's proprietary updates, the 2-year Treasury yield rose 2.8 basis points to 4.085%.
But at the exact same time, the 30-year Treasury yield fell 3.1 basis points to 5.110%.
Right.
So for a non-professional investor watching these numbers flash on a screen, seeing the short end of the curve go up while the long end goes down, well, it sends a highly mixed signal. Can we break this down from first principles? What exactly is this yield curve movement telling us about how money is actually moving through the real economy?
Correct. The most effective way to visualize this dynamic is to think of the yield curve as a series of thermometers, each measuring a completely different economic environment. The 2-year yield is essentially a thermometer for the Federal Reserve's immediate policy intentions.
And right now, that specific thermometer is heating up.
Exactly. Why? Because the April FOMC minutes, which are still actively reverberating through the market today, showed a majority of participants retiring the rate cut debate entirely.
Yeah, they flagged that potential rate hikes would be warranted if inflation persists.
Right. So the front end of the curve, which dictates the cost of short-term corporate loans and auto loans, is pricing in that near-term hawkish reality.
Okay, so the market is finally waking up to the idea that the Fed is not coming to the rescue with imminent cuts. But then you have the 30-year yield, which tells a different story entirely.
It does. The 30-year yield acts as a thermometer for long-term economic growth and long-term inflation expectations. And that long-term thermometer is cooling off today, primarily because oil prices are dropping on the back of optimism surrounding a potential Iran diplomatic deal.
Meaning lower oil equates to lower structural inflation down the road.
Exactly. So you have near-term rate hike fears pushing the short end up, and long-term inflation relief pushing the long end down. In institutional terms, this is a bear flattening at the front end and a bull steepening at the long end.
Right, let's translate that into the real-world structural tension we're seeing. If we look at the domestic economy, the U.S. consumer and the labor market are remaining remarkably resilient. I mean, we saw jobless claims come in at 209,000 today.
Which is a labor market that just hasn't cracked.
But if the U.S. economy can handle these elevated near-term rates, it raises a crucial question for you as an investor looking at international exposure. How are emerging markets handling this exact same rate environment, especially when they don't have the same domestic economic cushion?
On that point, our daily desk data shows extreme stress building in emerging market foreign exchange. The mechanics here are critical to understand. When U.S. rates stay elevated, the U.S. dollar tends to strengthen because capital flows toward the higher yield.
Right, capital chases the yield.
Exactly. And a dominant dollar puts massive crushing pressure on emerging economies that hold dollar-denominated debt. We are seeing their central banks being forced into drastic defensive action just to survive.
Give us an example from today's run.
Well, Bank Indonesia, for instance, just executed a 50 basis points emergency rate hike because the rupiah hit a record low against the dollar. They're essentially bowing to the inevitable after months of trying to hedge.
And it isn't just Indonesia. We're seeing this cascading across the globe. In India, the central bank just conducted a $5 billion forex swap auction to inject liquidity and artificially stabilize the rupee.
Yeah.
But the most alarming data point from our latest run is Turkey. Turkey is near liquidating its U.S. Treasury holdings simply to acquire the dollars necessary to defend the lira. I really want to highlight the mechanics of that specific action because it's like selling your landlord's furniture to pay your rent. It creates a brutal feedback loop.
That is an apt analogy. Let's walk through the exact mechanism of that feedback loop because it directly impacts domestic U.S. rates.
Right. When emerging market central banks liquidate their U.S. treasuries, they're flooding the open market with bond supply. This creates an underappreciated structural headwind for U.S. rates.
It means foreign demand for our national debt is dropping at the exact moment the U.S. Treasury is issuing massive amounts of new supply to fund the deficit.
Yeah, and we just saw this with the recent 4-week and 8-week Treasury bill auctions. They tailed, meaning they saw weaker than expected demand for the second consecutive week due to buyer fatigue.
Indeed. It's a self-sustaining cycle. Elevated U.S. rates pressure the emerging markets. The emerging markets are forced to sell their U.S. treasuries to defend their domestic currencies, and that very selling pressure dumps supply onto the market, which depresses bond prices and pushes U.S. yields even higher.
It's a hidden tax on the global financial system.
Moving to today's data, we have to bridge this concept of resilient U.S. markets to the highly specific, explosive price action we saw in global equities today.
Yeah, while emerging markets are fighting for their lives in the currency pits, we're looking at a massive bifurcation in Asia, driven by what we can really only classify as an artificial intelligence euphoria wave. Let's unpack the corporate moves driving this.
The moves in the Asian equity sessions were historic today. The Kospi surged 8.42%, marking its single biggest gain since early April.
That's a massive move for an index.
It is. And this rally was anchored by two major corporate catalysts. First, Samsung Electronics managed to avert a massive labor strike by agreeing to distribute roughly 40 trillion won, which equates to about $26.6 billion in bonuses to its chip manufacturing workers.
And it's worth noting for you, the listener, these are mostly stock-linked and long-dated payouts. By structuring the deal this way, Samsung removes a massive, immediate operational risk for the world's largest memory chip maker without entirely draining their near-term cash reserves.
Right. It provides stability to the global semiconductor supply chain right when demand is peaking.
Correct. And that stability bled into their peers. SK Hynix jumped over 11% on the session.
Meanwhile, the Nikkei index in Japan rose 3.14%, but the underlying breadth was incredibly narrow. That index-level gain was driven almost entirely by a single entity.
SoftBank.
Yes. SoftBank gained nearly 20% today, adding a staggering $36 billion in market cap.
A $36 billion single-day move is essentially adding the entire valuation of a major S&P 500 company in a few hours. What is the fundamental driver behind that specific flow of capital?
This is tied directly to the upcoming pipeline of major tech IPOs. SoftBank is uniquely positioned to benefit from OpenAI's imminent confidential S-1 filing alongside their own plans for a highly anticipated SoftBank Energy Unit IPO. Institutional capital in Asia is aggressively front-running these liquidity events.
So you have the Asian markets surging on hardware manufacturing and infrastructure narratives. Now, if we look domestically, U.S. equities also had a very strong session. The Dow hit an all-time closing high of 50,285.66.
But crucially, if you look at our daily desk data, it wasn't the mega-cap tech names leading the U.S. indices today.
No, it was the Russell 2000, which tracks cyclical small-cap stocks, closing up 0.93%, and the utility sector, which closed up 1.9%. We're seeing a healthy broadening out of the rally. However, there is a glaring anomaly in today's data deck regarding the undisputed leader of the AI trade.
NVIDIA. The NVIDIA price action is arguably the most important signal of the day. NVIDIA reported a completely blowout quarter. Data center revenues printed at $75.2 billion. Their networking segment contributed $14.8 billion, which represents a 199% year-over-year growth rate. They beat Wall Street expectations on both the backward-looking quarter and their forward-looking guidance.
And yet, despite that pristine fundamental execution, the stock faded 1.77% by the close. I have to challenge the pricing logic here. If you're an investor, this looks entirely broken.
It does seem counterintuitive.
Right, the fundamentals for NVIDIA are a blowout. They're essentially building the physical infrastructure for the entire global AI transition. And Asian tech peers are soaring 10% to 20%. Why are we seeing a negative price reaction in the U.S. leader?
The answer lies entirely in institutional positioning and the evolving maturity of the AI trade itself. Based on our latest run of institutional consensus and prime dealer desks, hedge funds have been aggressively net selling U.S. semiconductors over the past month to book profits.
So the market is beginning to fundamentally shift its focus. Let's dig into that shift, because this is where the mechanics of corporate tech budgets change everything.
Okay.
Early on in this cycle, the strategy for every major enterprise was simply buying intelligence at any cost. It was a gold rush to maximize token generation in massive, centralized, multi-billion-dollar data centers.
Yeah.
But our internal proprietary research indicates that chief technology officers are now shifting to a metric of cost per useful action.
Indeed. The focus is moving from theoretical capability to actual return on investment. Open source local inference models like Cursor and Llama are becoming highly capable.
Right.
These models, specifically in the 1 to 8 billion parameter range, do not require massive server farms.
Okay.
They can now run directly on consumer-grade hardware.
Like everyday Apple laptops utilizing unified memory or standard Microsoft machines equipped with dedicated AI accelerators.
Exactly. This completely fractures the existing compute landscape. Using a massive hyperscale GPU cluster in a remote data center to do a simple task like summarizing an email or drafting a memo is a bit like using a blast furnace to boil a kettle.
It works, but it's astronomically expensive and inefficient. If local consumer-grade hardware can handle these low-end inference workloads natively, the market is realizing that the world might not need infinite centralized compute capacity.
Correct. The bull case for NVIDIA going forward is that offloading these low-end tasks simply frees up their highly expensive GPUs to move further up the stack, tackling complex reasoning and autonomous agentic workloads.
But the bear case, which institutional capital is pricing in today, is exactly what you described. The rapid commoditization of the inference layer. Hedge funds are taking their profits on the primary hardware provider and rotating that capital out into the broader ecosystem, searching for the next derivative play.
Which brings us to the consumer cross-currents we are seeing in the broader U.S. equity market today. If capital is rotating into the real economy, we need to look at the health of the retail sector.
We're seeing extreme divergence here. Walmart fell over 6% today. This was driven by a same-store sales miss, but more importantly, it was driven by a strategic management decision. Walmart chose not to pass on $250 million in elevated fuel costs to their consumers.
They're eating that cost to protect their market share against aggressive pricing threats from Kroger's new CEO.
Exactly. And because the stock is trading at a lofty 44 times next 12 months price-to-earnings multiple, any imperfection in the margin profile is ruthlessly punished.
On that point, the divergence is stark when you look elsewhere in the sector. While Walmart struggled with margins, Advance Auto Parts jumped 19% on better-than-expected sales and targeted gross margin improvement.
Yeah, and similarly, Ralph Lauren jumped 15%. This creates a highly specific profile of the U.S. consumer. They are remarkably resilient, but they're becoming highly selective about where and on what they deploy their capital.
And the underlying cost pressure facing that retail consumer, particularly the fuel costs that compressed Walmart's margins, links directly to today's major movements in the global commodity complex.
Let's pivot to energy and geopolitics, because this is the floor holding up the entire market. WTI crude dropped 1.1% today to settle at $97.99 per barrel. This marks the third consecutive day of declines. What is driving this sustained move lower in energy?
The primary driver is diplomatic optimism regarding an Iran deal. Our daily desk data notes that Iran explicitly acknowledged the latest U.S. proposal, stating it partly bridged the gap between the two sides.
Which is concrete, constructive language.
It is. Crucially, this diplomatic progress is overshadowing the broader geopolitical rhetoric we are still seeing in the headlines, such as military posturing around the Strait of Hormuz or aggressive demands regarding uranium enrichment.
It's a classic case of watching what the market does, not what politicians say. The behavior here suggests that institutional macro funds fear missing out on a compression in the geopolitical risk premium more than they fear another sudden oil price spike.
They're betting that the worst-case scenario is off the table.
Right. The physical oil market participants might be split on the reality of supply, but the paper markets are dictating that crude drifts lower based on this incremental diplomatic progress.
Indeed. And that decline in oil is the exact fundamental catalyst, providing the long end of the Treasury yield curve, the inflation relief we discussed earlier. But when we look at precious and industrial metals, the narrative becomes significantly more complicated. Gold was functionally flat today, closing at $4,543.70 an ounce.
This is a major structural anomaly. I mean, on a day where the Dow hits an all-time record high and the Kospi jumps over 8%, you would expect traditional safe haven assets like gold to sell off aggressively as capital chases risk.
You would.
The fact that gold is remaining elevated and sticky on a massive risk-on day implies that investors don't fully believe the fairy tale. The geopolitical hedge bid is not going anywhere.
Correct. The market is pricing in incremental diplomatic progress in the Middle East, but they are emphatically not pricing in a guaranteed permanent resolution. Institutions are holding their gold as insurance.
Meanwhile, silver rose 1.27% today.
This outperformance relative to gold is tied heavily to the physical AI and energy infrastructure build-out we discussed with the utilities sector. Silver has a massive industrial application component.
Yeah, the intense power generation and thermal regulation required for these data centers are driving tangible, physical demand for the metal.
And yet, despite the silver rally, we are seeing a starkly different signal from the ultimate industrial bellwether, copper. Copper fell 0.67% today.
In institutional circles, they call it Dr. Copper because it's used in everything from residential plumbing to electric vehicles. It essentially holds a PhD in global economics. When copper drops, it means physical construction and manufacturing are slowing down.
And that decline in copper connects directly to a major divergence we are seeing in Chinese equities today.
That's a critical macroeconomic connection. While global tech surged in the US, Japan, and Korea, the Shanghai Composite was down 2.04%, and the Hang Seng Tech Index was down 2.15%.
Copper's decline is a direct leading indicator regarding Chinese domestic demand.
Right. Despite the global tech and AI boom creating trillions in market cap elsewhere, the internal macroeconomic environment in China continues to struggle with property sector deflation and weak consumer confidence.
The fact that Chinese tech stocks are selling off sharply, swimming directly against the current of a historic Asian tech rally, suggests that their domestic macro headwinds and regulatory overhangs are overpowering the broader global momentum.
It's a massive warning sign that the global economic recovery is highly fragmented, not unified.
Understood. Let's pull back from the individual asset classes and look at the synthesis of all this data. If you are managing risk today, what does this specific combination of moves tell you about the current market regime?
We have falling oil, a steeper long-end yield curve, a broadening equity rally into small caps, but simultaneously we have struggling emerging markets, sticky gold prices, and a deflationary drag from China.
The macro environment right now looks like a highly fragile illusion. It's a conditional soft landing. The market is betting on a very specific, very narrow needle to thread.
For this rally to sustain itself, three things must happen perfectly. The Iran deal has to actually materialize to keep inflation expectations anchored. Physical oil must stay below $100 a barrel to protect consumer margins, and the Federal Reserve has to remain paused despite the resilient labor market.
If any one of those three pillars snaps, the entire structure wobbles.
Indeed. The market is pricing in a Goldilocks scenario, but our latest run highlights two major red flags that heavily contradict the equity market's sunny optimism. The first is severe credit complacency.
Despite the Dow hitting a record high, high-yield credit, which tracks riskier, junk-rated corporate debt through the HYG ETF, was essentially flat today, up just 0.05%.
Let's explain why that matters to the listener. High-yield spreads are currently sitting near two-decade lows. A spread is simply the extra compensation, the extra yield, and investor demands to take on risky corporate debt compared to a ultra-safe U.S. Treasury bond.
Right now, investors are demanding almost zero extra compensation.
They're buying junk bonds as if they carry the same risk profile as investment-grade debt. They are not being compensated for the mounting risks in emerging markets, the ongoing geopolitical tensions, or the very real potential for a stagflationary environment if the Fed is forced to hike rates into a slowing economy. It is textbook complacency.
Correct. And that extreme complacency leads directly to the second major red flag in our data: squeeze risk. According to today's proprietary updates from prime brokerage desks, short exposure in U.S. macro index products is currently at a 10-year high.
This is a fascinating mechanical setup. Well, not fascinating, it's just highly notable. Investors are clearly terrified of the macro environment. They see the elevated rates, the oil volatility, and the geopolitical tail risks.
But rather than shorting single vulnerable stocks, they're using broad indices like S&P 500 futures to hedge their portfolios.
On that point, utilizing broad index shorts creates a massive vulnerability for the market structure. You have a situation where the underlying current of the market is a massive capital rotation. Money is moving from pure play AI semiconductors into the broader infrastructure ecosystem and from mega cap tech into cyclical small caps.
But because there is such a historic buildup of short positions at the index level, any positive macroeconomic news forces a mechanical reaction.
Right. When the news hits that the Iran deal is progressing, oil drops. The market ticks up. Suddenly, all those funds holding short positions on the index start taking losses. To stop the bleeding, they are forced to buy back their short positions.
That forced buying drives the index even higher, triggering more shorts to cover in a cascading loop.
It's a short squeeze on a macroeconomic scale. It means the record high in the Dow today is built on technical repositioning and forced buying just as much as it is built on fundamental optimism. And it is entirely dependent on that geopolitical relief holding steady.
That is the precise mechanical dynamic. If oil reverses its trend and spikes back above $100 a barrel, or if Federal Reserve Governor Waller delivers a surprisingly hawkish speech tomorrow that shocks the two-year yield higher, the foundation of this conditional soft landing could fracture very quickly.
And the forced buying would immediately flip into forced selling.
Exactly.
Quickly recap today's core takeaways for your portfolio. We saw the Dow hit a record high, driven largely by geopolitical relief that pushed oil below $98 a barrel, giving long-term inflation expectations room to breathe.
We witnessed a historic AI and IPO-driven rally in Asia, which masked aggressive, fundamental hedge fund profit-taking in U.S. mega-cap tech leaders like NVIDIA.
And underneath all this equity euphoria, hawkish signals continue to flash in the two-year Treasury, and emerging markets are liquidating assets to survive as the global system digests the reality that the Federal Reserve's rate cut debate has effectively been retired.
And as we consider the massive capital rotation happen within the AI sector, moving from theoretical intelligence gathering to actual cost efficiency, it leaves us with a critical, unresolved question regarding future market pricing.
If the artificial intelligence industry truly pivots away from massive centralized data centers toward highly efficient open source models running locally on your everyday consumer hardware, how long before we see a violent downward repricing in the utility sector, which has been rallying for months entirely on the projection of infinite hyperscale power demand?
Definitely something to watch.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.